income statement, the main items that we're going to look in an income statement from top to bottom: revenues, cost of goods sold, as you know, cash and non-cash. There's non-cash treatment of items like depreciation and amortization, selling, general and administrative expenses. Then we have operating income and EBITDA, financing income and expenses, earnings before taxes, extraordinary items, and then the net income and earnings per share, EPS. The balance sheet, as I mentioned, gives you a snapshot. It's a picture in time rather than a full period. So it tells you at the end of a quarter or a month or a year how the company is funded, and on the debt and liability side, and how those assets are there available to generate profits in the P&L. And then in the balance sheet we have assets equals liabilities and equity, both sides. On the assets we have cash, receivables, inventories, property, plant and equipment, intangibles, and equity investments. On the liability side we have payables, short-term and long-term debt, and other liabilities. And then finally on the shareholders' equity we have the paid-in capital, retained earnings, and minorities. Those are the main items. As I will show you, when we're modeling in Excel, we want to keep a balance between simplicity. We want to have the projections and the model to be simple, but at the same time we wanted to capture all the key items, and I think these are the key items that we always need to capture and have a strong hold on.
Really quick, what are minorities?
Minorities, okay, so there are instances in which a company, and it works both ways, in which a company can invest in other companies or in other projects as a minority investor. So it will have less than 50% investment in such project or company. This applies for conglomerates, for instance. And in those cases, the accounting principles indicate that if it's less than 50%, if you don't control the entity, it is an equity investment. It will be on your asset and the asset side of your balance sheet, because it's an investment from the company in another entity that it does not control. The other way is if you have other entities that are investing in your company. Like for instance, there's another company that is an investor in one of your subsidiaries. They don't control, but it's a significant investor. Those are minorities, and you need to reflect them because there will be cash outflows most of the time to pay to those minorities.
So minorities could be on either side of the balance sheet?
It's minorities if they're on the equity side, and it's equity investments if it's on the asset side. Okay? And then finally, the third financial statement is the cash flow. This is the most important financial statement to analyze. This is really where you can see if a company, a project, an entity is creating value, or if you're getting into trouble and there's going to be more capital requirements, and then you connect that with the balance sheet and figure if you have a financing risk or balance sheet risk. The cash flow statement analyzes cash movements from operations, investing, and financing activities. Those are the three items that you analyze in a cash flow. Operations will include cash earnings, so net income, that's the net income for the period, adding depreciation and other non-cash items that were already deducted in your P&L to reflect the cash flow. Your net working capital movements, so if you have inventories, you have receivables, and you have payables, the net figure, whether it's positive or negative, or on the asset side or liability side, and the change from period to period of that net figure will indicate whether there's an outflow or an inflow from working capital. And that's also a very important item in terms of the operating cash flow. Investing activities will include primarily capital expenditures, but also includes divestitures, liquidations, and also acquisitions. So if a company is doing emergence and is very involved in M&A activity and it's acquiring a company, it will be in this part of the cash flow statement. If it's liquidating or selling out a subsidiary that is no longer strategic, you will also see an inflow you see a reduction in your asset side, and you see an inflow on the investing activities rather than an outflow. And then finally, financing activities. This is where everything ties up. You have your debt repayments or debt additions, depending on your cash surplus or deficit. You also have here your dividends. And finally, the net, after adding the three items, would be your net cash position at the end of the year, which then ties back to the cash to the balance sheet. So it's your first line item in your balance sheet is your cash position. So it's a result of your cash flow for the period. A little bit more details as to how the three statements are connected. I already explained a little bit. These are interconnected. In Excel, you want to allow for circular references when you're doing these projections. For the historical period, everything is already calculated and everything ties up. The accountants do that work for us. But when you're working on projections, part of the modeling is modeling the cash flow and figuring out the effect of that cash surplus or deficit after all your assumptions. So if there's a, I'll give you an example. If the company is the starting point is with a balance sheet that is highly indebted, your first year of projections, the company is growing a lot, so revenues are growing. It needs to invest. CapEx is also growing so that we have the equipment and all the technology to provide for that growth on your top line, and you're generating income. During that period, you're also depreciating your base, your historical assets. You're also depreciating whatever you invested throughout that first period. And because you're highly indebted, you're paying interest, and you're also probably paying out principal. So if during that first year of your projections you want to grow at a certain level and you're already stretched in your balance sheet, what the cash flow will tell you is that you have a cash deficit. You calculate everything, and then your starting cash, let's say, is 100. Your ending cash is minus 200, so you have a deficit of 200. The way you interconnect everything is using that deficit to calculate your debt or your capital requirements. So it's a 200 deficit. You tell through some formulation that I will show you, you tell the balance sheet that you need to add 200 in debt. So the cash flow registers an inflow of 200, the balance sheet grows by 200, and then your interest expense grows, so your net income decreases. And you need to recalculate again the whole period. And what Excel does with the circular references, it does that calculation for you. It iterates until it matches the three sides, the income statement, the balance sheet, and the cash flow statement. So in the end, your balance sheet balances, and assets are equal to our liabilities and equities. So that's why you need a circular reference. Yes, got a question?
No.
So, before we go into financial Excel modeling, are there any questions in terms of the accounting and circle reference, how these things are interconnected? No? Just increase the size of the screen so we can look at it here. Alright, so now what I'm going to show you is a real example of how to build an Excel model. This is a real company, Alpha SAB. This is an industrial conglomerate based in Mexico with global operations. The company has 4 business units, and as a conglomerate, all those business units are really not interrelated. So we have independent calculations for your top line, for your revenues, and you have different cost structures. But the company is operated as a conglomerate, so you have consolidated figures. So what I'm going to show you first is the historical analysis. What we have here, everyone has the same file, right? You have that file in front of you. So what we have here is, if we go to the projections tab in the alpha 1 file, so the historical numbers for the last 6 years. I actually have a little bit more of history. By the way, if you're not very familiar with Excel, Excel gives you the ability to add tabs, almost as many as you want to add. So if you go here to the very end of the file, you can click on this icon here, and it just adds sheets. And this is very helpful and useful because it allows you to add sheets if you want to have different aspects in your analysis, and you can also connect between sheets. And you'll see how my tabs are connected in this case. Let me show you very quickly what I do here is I have 2 tabs that are called Financials Q and Financials Y. These are quarterly and yearly figures, historical for this company. You won't be able to do this, but I just want to show you some functionality so that you might apply it in the future. What I have here is a direct connection to Bloomberg, and Bloomberg allows you to download historical data. It's a massive database, and we use this a lot in our work, in our office. So what I have here is the historical financials. I have reduced the items to those that I think are essential. So as I mentioned, you want to keep it very simple, but keep the key variables in your model. So I have revenues, cost of goods sold, SG&A, depreciation and amortization, etc. So I have all the income statement lines, and I have, as I mentioned, the yearly figures starting in 2000 all the way to 2011, and shortly 2012 will be available. And I also have quarterly figures here with the same breakdown for the income statement, balance sheet, and cash flow. As you can see here, the balance sheet is very simple. I'm just having the main items on the asset side, and also the key items on the liabilities and equity side. You can see here minority interest, for instance, which was one of the questions. In this case, this company has minority investors, and you need to account for them here, both on the balance sheet and on the income statement, right? You need to have both items there recognized. And then cash flow summary. So all those figures, what I wanted to show you is that all these figures for the quarterly and for the annual figures are then connected to my historicals here in my projections tab. So if you go to cell E164, you can see that here I'm saying if is there financials Y. So I'm calling the data from the yearly financials for that period, and if it's an error, I just leave it blank. If it's not an error, then I add the data. So this is one example where you can use it, and it's what it does is it allows me to have clean data in my historicals. Okay, I have the same for revenues, for total COGS, SG&A, etc. I'll walk you through the spreadsheet one, because this is the first step of building projections. You have a historical period, usually 5-6 years. This applies not only to companies that you're analyzing, but also projects. So you want to have some historical analysis if there's some precedent. You have revenues, cost of goods sold, gross income, SG&A, operating income, and EBITDA. In each case, what I'm doing is calculating the margins or the cost as a percentage of revenues. And I'm also calculating the growth. So you can see here the revenues was 76, 106, 116, and what I am adding is a line that translates those figures which are in local currency to US dollars, so I can have both local currency and US dollars, and I am calculating the growth with the same growth formula that I showed you earlier, both in local currency and in US dollars. Cost of goods sold, again, this is I bring it from the historical financials. The difference between revenues and costs would be my gross income, and then I calculate the gross margin as a percentage of revenues. Same goes for SG&A, and here I have two items, one as a percentage of revenues and growth. And all these things will be important because these are the key ingredients to build your projections. From the data that I'm showing you, we're gonna determine the drivers, the earnings drivers, the cost drivers, and build our projections based on assumptions. Same goes for operating income. I include EBITDA, which is operating income plus the non-cash items, depreciation and amortization. So you can see here I have grouped the cost structure. And let me backtrack a little bit. I told you this is a conglomerate, so it has 4 divisions. What I'm doing is I'm ungrouping the top line, how the revenues are built. In this case, this company has a petrochemicals division, OPEC. That division has 4 main business lines of business. All this comes out of analysis. You need to read the financial statements, you need to read analyst reports, and determine how the revenues are built. These will typically not be part of the financial statements, but you can build them through analyzing information that is available. Same can go for a project or for a company that you're analyzing, and you can build up your historical projections. So what I'm doing here is I'm building my revenue drivers. The revenue drivers will be determined by business segment, and within each business segment, the revenue line for that business segment will be built with 2 key drivers or 2 key variables. One is price, the other is volume. Price times volume equals revenue. So that's what I'm doing here. So the first step for the first business division, OPEC, is to determine the historical volumes. And this would typically be in thousands of metric tons per year. So 300,000 metric tons is 680, so on and so forth. And then I'm just adding up with this function, sum the range. You get the addition of the total volumes. Then I get a volume growth year over year. And remember, this is a historical period. So with these growth figures, and some analysis and some assumptions, I can build my projections when I open up the 2012 to 2015 period. So that's why it's important to keep this level of detail open. Oh, and another thing, in this case, in the historicals, we have the actual data, and we're calculating the growth, right? This is the growth in volumes. What we're going to do in the projections is we're going to do it the other way around. We're going to start with the growth assumption and calculate the volumes. So what I'm going to do is I'm going to open up the projection briefly so you can see how I'm doing that in the case of the revenue drivers for this business division. So this is the last historical period, total volumes of 5.7. Starting my projections, my key variable will be coded in a different color to indicate that this is an assumption. The assumption must be backed by analysis. There just has to be some rationale behind your assumption. And what I'm doing is I'm taking the historical volume for each of those business lines and I'm growing it by that percentage. So that goes back to your first question. How do you build that assumption? It's just an assumption that you build out of analysis, but you apply the same growth concept.
So the 7% is just one hypothesis that
it's an hypothesis, yes. So in this case, what we're saying is this is a consolidated market in North America. These guys are the number one player in PET, nylon, and fibers. They have contracts with their clients. These are resins that are used in consumer products like plastic bottles, for instance. And we know that those industries, or apparel for fabrics, we know those industries grow at 1.5 times GDP. So if you assume that GDP will grow 4% in Mexico, 2% in the US, 2.5% in Canada, then you come up with roughly 7%. It's not exactly precise what's here, but it's to give you a flavor of how you would derive those kinds of assumptions.
Those assumptions would probably be on the order between like 3 and 7%, right?
Yes, for mature industries.
Maybe if you're like in China, you might assume a little bit higher.
Exactly.
And then how fast the economy grows.
Yeah, and those will also be tied back to the demand dynamics. The demand dynamics will be a function of demographics. So clearly demographics in China are very different from North America, right? So.
That's right. I mean, maybe this is obvious. So the other numbers that are not included are the historic values that you work with.
Exactly. So the historical values, this is just a calculation. You know the historical volumes. So you see these are hard numbers. These are just hard-coded into an Excel spreadsheet. My first step is to calculate the growth rate year over year for each of those lines. And my first year of projection, I say, okay, this is one of my drivers. Mm-hmm. This will be my key variable that I'm going to make my assumption on, the growth in volumes, and I will calculate my volumes as a function of that growth rate.
Why do you suppose that the growth is going to be the same for nylon and for polyethylene? I mean, for the different.
Yeah, that's a really good question. You need to do an analysis for each of those line items.
This is just because this is an exercise.
And in this case, that 7% was derived from conversations with management. So you can also talk with the guys that are in charge of these businesses. The differences between the different lines were so small that 6 to 8% was a range given for each of those line items. So we decided to use the same range, but you can decide to use different assumptions based on your analysis. You can see going forward it's different. We're making different assumptions from different for different line items.
I have 2 questions.
Yes.
The first question is, in Excel, at the very top left-hand corner, you have the 1 and the 2 tab. How do you insert that into Excel?
Oh, okay. That's a good question. So you saw that I grouped, right? Because first I wanted to show you just the financials without the projections, and I opened up so you could see how the top line is built by business division, and then I opened up this to show you the projections. The way you do that is very simple. You let's say you want to group everything in your income statement below the EBITDA line. So your net financing, your non-operating expense, etc. And you just want to go from taxes, etc. You just want to go from EBITDA to net income. So what I did was select the range from the rows, okay. Line or row 210 to 225. If you go here to the top, you have File, Home. These are the different default options. You go to Data and go to Group and click on Group, and this will group. Now, because I already had groups here, Excel is giving you by default the primary group and a secondary group. So if you're nesting another group within a group, then you see the 1 and the 2 and the 3 groupings within groupings. Now you can do ungrouping it also. Select the same range, go to ungroup, and that's it.
And how do you get that table up top or to the left when you're scrolling? It remains there.
This one here?
Yeah.
Okay. This is also very useful because you wanna keep track of the year throughout your projections. What you do is okay. So I unfroze panes. what you do is you go back again. Hold on, this got slow. Basically, you position the cell where you want the grid to be fixed.
Mhm.
Go to freeze panes, select, and then it'll be fixed.
Okay.
Oh,
Yes.
one more formatting question. It looks really cool when you get rid of all the grid in Excel.
Mm-hmm.
How do you do that?
Oh, okay. Sorry?
You just highlight and click white?
That's one option. There's another option. Hold on, let me just. It's like frozen here.
Can you try to open
You could, yeah, you could.
At least the recording window looks like. Can we try alt tab out of the recording window?
Nope.
That's super frustrating.
Yeah. I don't know what's going on.
try opening another Excel file at the bottom?
Let's see. No, well, I mean, let's see. Well, we figure this out. You go to the file. Sorry, to the view settings, and you can select the page layout. So you can for instance, select just what you want to print, and that's what's going to show. And you can also, there's also another option that allows you to get rid of the grids without formatting white. And that's what I do here.
The view tab has a little checkbox.
Yeah.
Can you try the video, stopping it and saving it?
Let's see. Well, you see, the thing is, it doesn't allow me to change from this screen.
Click Shift F10.
Shift F10.
I think it's because he didn't minus the box to the recording. It's over in the corner. You put it down in the corner.
Okay.
Really? Okay, yeah. It doesn't have the little icon in the corner like it used to do.
How about pushing escape? See what happens.
There it is. Let's see.
And then at the bottom, click on the little camera.
Here.
No, see next to the English.
This one here?
Yeah.